A very good morning and welcome to this course on discussion on this entrepreneurial manager. And this we want to see a topic from Unit 4, which is the financing of an enterprise. And here we want to see a very important topic today, angel financing. So let us quickly get into that. Yeah. So this is the overall contents which you are going to see today. So you can see clearly we're going to see a very in-depth, have an in-depth discussion on the topic. So what is angel financing? So angel financing is basically a early stage funding for the enterprise. Now, this is being provided by whom? They are provided by actually wealthy individuals. So those are called angel investors, often called high net worth individuals. So these particular wealthy individuals invest their personal capital. So this is very important. They invest their personal capital in their high potential startups. And they provide both capital as well as mentorships. And these are ideal for businesses at a very at an idea stage, prototype stage, or early revenue stage. And why angel financing is very important for organization is the entrepreneurs, the raising capital is always a source of challenge, and angel financing provides the much required leverage, and they support innovative, risky businesses normally which banks avoid, and they encourage entrepreneurship and job creation. And what are the key characteristics of angel investors? Is they are high net worth individuals. They typically invest between 5 lakh to 5 crore, and they invest their own wealth, not the managed funds. And they very actively mentor and guide the founders, and they prefer high risk and early stage startups and flexible fast decision makers. What are the various types of angel investors? We have the individual angels, which are experienced business people, and we have the super angels, which are high value investors, and then we have angel networks, where, for example, if you talk about the Indian Angel Network, where the groups are pooling the money, and we have the incubators and accelerators, and we have the corporate angels, for example, like Tata Group as well as Reliance Group. Those are also coming under they come under the corporate angels. So what is the process of getting the angel financing is first we need to do a startup has to do a preparation in terms of pitch deck. They need to have a prototype. And then they need to network and find out the investors. And then after that, investor screening and testing happens. And then business evaluation of the startup pitch deck, everything is done. And also due diligence is also done. And then finally, then comes to the term sheet discussion and investment in exchange for equity. Now, these are the documents which are required. Pitch deck is required, and business plan model, financial forecasting of the organization for the next 3 to 5 years. Market research is very important. That is also required. The profiles of the founders are also required. Then prototype, MVP, minimum viable product, and company legal documents, incorporation, GST is also required. Now, what angels look for a startup is they need to have very strong founder team, and the solution, the problem which the particular startup solves has to be very, very clear, and it has to be scalable and innovative. And the particular startup, the business which they are into, should have a very clear market size and also has a very good high demand potential. And they should have an early traction on the revenue generation, or they should have a proof of concept. Now, how angel financing helps enterprises is they provide capital for product development, hiring and team building, and they build mentoring, industry knowledge and network and access, marketing and customer acquisition, and open the doors to future venture capital rounds. So, whereas these are the forms of angel financing, equity financing, the common investor gets ownership, safe notes, simple agreement for future equity, revenue based financing, rare but growing. Based on the revenue, the financing is done. And convertible debt, the equity is getting converted and loan at a later stage. So, these are the various forms of angel financing. Now, what are the advantages of angel financing? Suitable for early stage startups, and the very important thing is there's no repayment pressure, unlike your loans, and mentorship and industry guidance come in very crucially with respect to angel financing. And definitely, every part will have a two sides of the coin, like an advantage, disadvantage. What are the disadvantages if you see? And there is definitely equity dilution, ownership loss because of the equity which is coming in due to this financing options. And there are definitely chances of very possible inference in this business decision because angel investors like to have very great say in the running of the business. High investor expectations. The expectations is definitely going to be high when they invested the amount, and due diligence will be definitely very demanding and not suitable for all businesses needing large capital in early stages. So this is some of the thing. And angel financing versus venture capital, this is the comparison. So we can see that it has been compared with venture capitalist. So which stage this is suitable, what is the size of investment, risk appetite and distance spread and control. So angel networks in India, these are some of the angel networks prominent to be named as this the Mumbai Chennai Angels and Venture Catalyst Hyderabad. These are some of the angels networks very active in India. And government support is also there for angel funding. SIBI, the incubators funded by Niti Aayog, Startup India recognition, these are also coming under that. And what are the best practices for startup speaking angel funding is you need to have a very strong prototype and you need to present, market and validate and show traction and then prepare a clear and visually appealing tech pitch. Demonstrate founder the commitment as well as the vision and know your valuation and dilution expectations. So dilution is when actually you can allow the particular angel funding to come out. What is in period of the time period? That particular time period of exit is also very important for the angel fundings to come into your decisions. So emerging trends are for this one: rise of micro angels, low ticket investments, angel syndicates to digital platforms. We have also sector focused angels today based on agri tech, health tech, and AI. And today there are women led angel groups and impact focused angel investing. So to summarize this, angel financing plays a very, very important role and they offer early stage capital and mentorship, which is very crucial for organizations and market access. This is very ideal for startups which are highly innovative and they are having high potential and high growth. And this particular acts as a foundation, whereas, for example, if we're able to get a angel foundation, then definitely venture capitalists and private equity funds are definitely going to attract other people. So that's all. Thank you very much for patient listening. Thank you.